Hello, everybody, and welcome to this short video on market timing and bear markets in 7 charts. My name is Joe Allaria. I'm a partner and wealth advisor of CarsonAllaria Wealth Management and also the host of the Retirement Power Hour podcast, which you can find on Apple and Spotify and multiple other podcast platforms. And we just did an episode on this topic, this sort of investing in a crisis. We did one on bear market strategies, and we really talked at length. I had a couple different guests on in episode 3 and episode 4, but we really talked at length about these topics. But I want to do a short video so that you could see these charts, and hopefully it helps add perspective for you on these issues on bear markets. Because I think if you have more perspective, it will lead to better outcomes in the long run. So if you want to hear more, go to the podcast, go to, again, Apple Podcasts, go to Spotify Podcasts, and check out the Retirement Power Hour, or go to our website, CarsonAllaria.com, and you can find more information there. But without further ado, let's jump into these 7 charts that talk about bear markets and market timing. So the first thing, when we talk about market timing, I think everyone understands the goal is that people are trying to avoid bad markets, and no one's ever trying to jump out during a good market. So, we're talking about bear markets and avoiding them. And a lot of times people get the idea that, if there's a bear market, that, something really, really bad is happening, or things might get worse. So, the first thing to understand is that bear markets are actually really common. And this is a website you can go to. It's provided by capitalgroup.com. So you could search for that online. It's this one's 6 charts about corrections and bear markets from Capital Group. And again, it just says here, the first thing is that market corrections are actually very common. So if you look here, the average frequency of a 5% or more drop is about 3 times a year. The average frequency of a 10% or more drop in the S&P 500 is about once a year. Every year we experience about a 10% drop from peak to trough. And then 15% or more is about every 3.5 years, and then 20% or more is about every 6.3 years. So just knowing that and just understanding that, I think will give you more perspective the next time that we're in a bear market. Just understand that, okay, this is not the first time this has happened. It's not going to be the last time. This is quite normal. And as advisors, I can tell you that I expect this to happen. 20% or more decline is a bear market. I expect that to happen every 5-6 years. And it could happen more often. Again, this is just the average from 1948 to 2017. So it could happen more often. Obviously, it's not on a cycle every 5 years. So that's the first thing to understand, that if you happen to find yourself in a bear market when you're watching this, I wouldn't get too worried thinking that this is a rare occurrence, because it's really not. And the second chart I wanted to show, again from Capital Group, is how markets have recovered after having a downturn. So this just shows the average 12-month return after a, quote, steep market decline. Well, what's a steep market decline? Well, you can see down here a decline of at least 15% in the S&P 500's index value. And so what happens after the S&P 500 declines by 15% or more? Well, this chart shows the average 12-month return after that has been 55%, which to me is just astounding to see the average return. You can see all the dates on the left here of those 12-month, those 12-month periods, but the average, some of them are that show, more than 12 months. But if you just look at the 12-month period, so you just had a 15% decline, and then the subsequent 12-month return, 55%, which is just absolutely, again, astounding. But the thing that happens is that people, when you have a downturn, 15, 20%, a lot of people get worried that the market might go down more. And so what do a lot of people do? They get out of the market, they sell, they go to something really, really safe, because they don't want to see their account value go down anymore. Well, obviously, you don't want to do that, because you're selling something after the value has really declined. And then more than that, if you look at what's happened here, you look at the data, chances are you're going to miss out on a huge upside if you don't just stay put, and if you don't stay invested. There's history shows the average return after 12 months, after a 15% or more decline, 55%. I'm going to skip that one. I'm going to go down to the next one, my number 3 here on my list, because I've got 2 different sources, but this one is, again, same page from Capital Group, but it talks about bear markets and how short they are. So how long is a bull market, or how long is a bear market versus a bull market? Well, you can see on here the average return, first of all, cumulative return for a bull market, 263%. And a bull market, the average duration is about 71 months. And again, this goes back from I think this just says 1949. There have been 9 periods of 20% or greater declines in the S&P 500. And while the average 33% decline, that was the average bear market. Okay. You can't forget about the average bull market return, which is 263%. So, and also the other thing to know about bear markets, the average length was only 14 months. So you look at it this way. If you experience, you go back historically speaking, you experience bull markets, on average, you experience an uptick of 263%, and you were in a bull market for 71 months on average. But every time you endured that, if you stayed invested, then you also had to endure every once in a while a 33% decline, and you had to endure a bear market that lasted 14 months. But like we try to explain to many investors, if you just stay invested and take the good and the bad, you can see here, these mountains are a lot bigger than the valleys. So you don't need to dodge the bad. You just need to get all of the good. And the good is the bull market. The problem is we don't know when these valleys are going to come. So you can't just say, well, I've been invested for 71 months, so I'm getting out of the market. It doesn't work like that. You can see they are sort of spread out, but they're not exactly spread out. So we don't know when those bears are going to show up. But it's so important to stay invested. The problem is, this is the next one I want to show, this next chart. The problem is that people, again, like I said before, they, instead of buying low and selling high, they buy high and they sell low. So the market starts to go down, and after it goes down, they get uncomfortable and then they sell. And they say, well, I don't want to get back in until things get better. Well, at that point, it's not too late, but you missed out already on a lot of return in the market. So you can kind of see here the net asset flows versus the S&P return. So this is saying when the S&P went down here in this line, you could see all the selling that took place when it went down. Okay. And then it comes back up, and then still people are kind of selling. This is from 08, 09. Obviously people didn't want to be in the market. So some people sold after it went down. Some people said, well, when the market came back, now I'm going to try to sell. And then you can see here, when we had the market kind of coming up again, we had record net buying, but that was as markets were reaching their all-time highs in 2017 and 2018. People were buying when the market was at its highs. And we're not saying don't do that, because you want to invest with a long-term view. But clearly what happened is we had net selling as the market was reaching its bottom, and then it continued during much of the bull run in the S&P 500. This is not a chart of, by the way, of the S&P. This is the chart of the returns of the S&P. So it's different. So it looks kind of flat, but that means it's kind of a steady positive return on this top part here. So we have selling when the market's down, buying when the market's up. Obviously not what you want to see. So that's 4 of the charts. We got 3 more. I'm going to switch to a different screen because I want to show this other page here. And here we go. So that kind of speaks a lot to behavior. And this talks more about this. When do the best days in the market come? Usually after the worst days. So we could see here, the 3 of the worst days in the market since 1950 came in 2020. And it was March 16th was the second worst day of the market, March 12th and March 9th. So the second, third, and the 9th worst days in the market since 1950 came in the same month in 2020. And you can see the S&P was down 12%, 9.5%, and 7.6%. However, the return after that, just 1 year later, you could see 69%, 61, and 43.6%. But why did that happen? Because to get that sort of return after you have these really big down days, you got to have really big up days. Okay. And you're most likely going to have those. And when are those going to come? Well, now you can see 5 of the best days in the market since 1950. March 24th, and these are in order of how good they were. So the third best day, March 24th, 2020. The fourth best day, March 13th, 2020. The seventh best day, April 6th, 2020. The 12th best day, March 26th. And the 13th best day, March 17th. And you can see the returns each of those days. So again, try to fight the urge when the market goes down. Try to fight the urge to say, I have to get out because I'm afraid the market's going to go down any further. If you just keep this perspective, and remember, the best days usually come somewhat, relatively soon after the worst days. Again, it's never a guarantee, but if you keep a long-term vision, a long-term view, that's, I think, probably the best thing you can possibly do. Right now, I'm doing this video in April of 2022, which doesn't really matter, but this chart talks about how satisfaction level is often a contrarian indicator of the market. So, if you look at satisfaction level, when satisfaction level is low, that tends to bode well for market returns for the following 12 months. And so here in early 2022, satisfaction level was pretty low. But if you look over here, stock market returns for the next 12 months, when less than 34% of people are satisfied, have been 15.2%. When 34 to 50% of people are satisfied with the way things are going in the US, the market returns have been about 12.4%. And when people are really happy with how things are going, then the market only returns about has returned about 6.1%. And this goes back to April of 2000, every month going back to April of 2000. So it's interesting data. It doesn't really, it doesn't tell us exactly what's going on, but it just tells us that when things are bad or people aren't satisfied, it's not all over. And that's oftentimes, it might not be a bad time to be invested. And the last and final chart that I just want to show to give you, again, as much perspective as we can get here in this short video, is just look at this mountain of a chart. This is the stock market going back to 1926, 1925, the end of 25 through the end of 2021. And again, you can see the positives and the minuses. And so this is the bull markets on top and the bear markets on the bottom. And you can see that the bear markets are absolutely dwarfed by the bull markets. You had here, I'm just going to pick somewhere in the middle. Here in the 50s, 60s, you had a 936% bull market, followed by a 22% bear market. Then you had 144% bull market, followed by a 29% bear market. Then you had 76, followed by 43. Then an 845. Followed by a 30%. And then an 816, followed by a 45%. You guys get the idea. So perspective is so important. And you're not going to be invested for, almost 100 years. Most likely, you're not going to be invested that long, and that's understandable. But, when we say long-term, I think 10 years, even if you're 75 years old, if you're watching this, you could easily live another 10, 20 years. Unless you have a terminal illness. And a lot of you watching this that are younger, maybe you're still working. Gosh, this is so important to keep in mind. don't fall for the trap of, you hear people talking around the water cooler at work, and, they're saying, well, I'm getting out of the market 'cause things are going to get bad. They very well might, but they also might not. And the only thing worse than experiencing a down market and experiencing a 29% decline here, or I guess I should say a 43% decline here, something worse than that would be missing out on this 845%. So keep that in mind. These were 7 charts. This one is from BlackRock. It's BlackRock Student of the Market. You can go online and find that as well. So we had Capital Group and BlackRock today providing the charts. If you have any questions or concerns or anything like that, always encourage you, please reach out to us. You can go to CarsonAllaria.com. You can schedule a 15-minute consultation. If you're not a client of ours, a personal wealth management client, we will do a free retirement analysis for you to educate you on some of these things, show you some things that you might be able to do. But I just want to shoot this very short video and keep it under 20 minutes so that you could get all of these charts, get a lot of perspective, and hopefully it helps you. Whether, right now, currently as I do this, we're not currently in a bear market, but in the future at some point, I'm sure we will be again. So hopefully you're watching during that time, and this can give you a little bit of peace of mind. With that, thanks for watching. Again, I'm Joe Allaria. Tune in next time. Have a great day.